Well, we're putting the spotlight on frontier markets right now. So let's take a look at it, because there's a debate as to whether now's the time to be venturing into frontier markets in the first place, with risk aversion so high.
Well, look, I don't think that investors have any choice going forward but to look at frontier markets. If you look at developed markets, they have low growth going forward. They have high debt going forward. You look at frontier markets, they have opportunities, they have high growth, they generally have low debt. And frontier markets really are where emerging markets were 20 years ago. If 20 years ago you had put money into emerging markets rather than developed markets, you're way ahead now in terms of investments. And we think that this is where people have to go.
They have to go, but what kind of appetite is there out there for it, especially if you're looking at frontier markets on the African continent?
Well, you know, I think the appetite is there. People are scared to pull the trigger at the moment, given where this risk aversion is at the moment. I mean, we're speaking to clients. I just came back yesterday afternoon from Chile. The Chileans are very advanced in terms of where they are putting their money. They have 80% of their money in emerging markets, and they're saying they know that frontier markets are where they have to go. Yes, they may have some concerns about doing it today, but they're saying, you know, in the next month or two, they have to start moving their money towards frontier markets. And when you're speaking to clients in Europe or clients in Asia, everyone knows that they need to look at frontier markets. Many of them, yes, you're right, are on the African continent, but Africa as a continent, 6 of the 10 highest growth countries in the world are in Africa. It's the place to go. It's where the resources are, where the consumers are, and where the spend on infrastructure is.
Yep, so let's take a look at just how keen investors have been and where they are interested, the primary markets that they're looking at right now. If we're starting off on the West Coast, of course, you've got the hub being Nigeria, and it's certainly where a lot of focus is at. And it seems like we've made a lot of stride in that economy, specifically with banking reforms coming through in a big way. So what's the perception out there of Nigeria, and is it shifting fast enough?
Yes. Well, yes. Look, we always want things to shift faster, okay? But yes, I think it is shifting. I think, you know, the Nigerians have done a lot of work on their banking system. The banking system is pretty much sorted out now. There was the last little change they made sort of about last month, where they took some of the very high loans that banks had to certain companies and reduced that and put them into AMCON. So we think that's very good. Nigeria, we believe, by 2020 could be as large as Canada in terms of GDP. I mean, this is huge. You know, hundreds of millions of people in Nigeria, consumers, wealth. If you're not in Nigeria in the future, I think you're going to lose out. And
that's exactly where the focus has been, because of the consumer base that you mentioned. It's that population that investors are looking to leverage off, and with that, not only the banking sector, but you've had the likes of the fast-moving consumer goods sector fast moving into the spotlight as well.
You have. You know that Nigeria is the largest single market in the world for the Maggi stock cube. Okay, I mean, it's quite phenomenal what people are able to buy and what people are spend there. Yes, it's still early stages. Most of what's being spent in Nigeria is still through informal markets rather than the formal channels, but the opportunity to grow is there. And if you even look at fast-moving consumer good companies, people are paying quite a lot of money for them because they realize what the opportunity is in Nigeria from the consumer.
In the face of what kind of risk, though?
Well, I think that the risk is lower if you're in a developed market where the growth is 1% compared to Nigeria where the risk is 8%, you know, in terms of GDP growth. So, yes, there is risk in terms of currency risk and inflation risk, but I think given a decent investment horizon of 5 years, I think you have less risk in Nigeria where there's growth than you do somewhere else.
Of course, when it comes to that philosophy on risk and you know, how to not lump all of your eggs in one basket, we've had the East African community as a region standing out. Yes, Kenya you know, sits as the hub to it all, and pretty much the gateway to that region, but with the East African Common Market Protocol having been signed, it seems that investors are being lured that way in the kind of potential that region as a whole boasts right now.
Yes, I mean, for Africa, our two most exciting parts, as you say, Nigeria and East Africa. You know, Kenya for us is a hub to all the countries to the east of it who have oil, who have wealth, but don't have access to the sea. Rift Valley Railways is being revamped. They're going to put more on it. There's a new port coming into place. So for us, East Africa, Kenya is a tremendously exciting place. At the moment, there are some constraints there. You know, we've seen inflation go up. They've had to put interest rates up to counter that inflation. So that is one of the concerns that we have. but it's a short-term concern. Longer term, there's a 200 million people in that area who are consumers. There's oil, there's infrastructure, and just further south, we've just had this massive discovery off the coast of Mozambique, a huge oil field. I mean, this is a game changer for Southern Africa.
Let's put that macro picture under the spotlight, though, because it's certainly that has put pressure on the NSE 20 index over the recent past. Those banking stocks have severely been hammered, and that on the back of rising rates. It's sitting at 18% right now, and many very concerned about what this would mean for the banking sector, specifically in the form of non-performing loans moving down the line.
In the short term, it's negative. You know, the longer that we have interest rates at 18%, the more businesses or consumers are going to battle to meet their sort of repayments. Okay, but Kenya is not a tremendously highly indebted society. I think there is scope there. It will have short-term repercussions on earnings per share for banks, but if you're looking out over the next 2 or 3 years, I don't believe it's a huge issue that we need to take care of. In fact, for investors, it can be an opportunity. You know, Europe for us in Africa, I think, has been a huge opportunity, because while we're going to see some slowing in the economies, in general, they're still growing at over 4% or 5%. And we're able to buy companies that are 20% cheaper, while the economies are maybe 5% less than they were. There's an opportunity there.
How do you identify that investment opportunity specifically? Because when it comes to the bank, of course, one of the key considerations would be to consider just how well capitalized, I assume, they are.
You know, that's one of the things that in all our markets and our whole investment philosophy is to buy the quality companies. So, you know, in terms of banks, we want well capitalized banks. We want loans that are nicely spread. We want banks that have got a good base in terms of access to their clients. So those are all things that we look at. And we have a team here of analysts who spend their time doing that, looking at it, visiting the companies, visiting the countries, and finding those opportunities for us.
Next year, of course, brings interesting times for the Kenyan economy. We're heading into an election here, and we know what happened the last time round that's made investors a little bit more cautious. To what extent are you viewing that as a risk, and a risk that you're pricing in?
Well, we do think it's a risk. I mean, if you go to Kenya, and I was in Kenya not long ago, they're having a huge tourism season at the moment. There are so many people, all the camps are full, everyone's busy there. But there is some concern that next year bookings are going to come off, just because people are concerned. Of course, we're not seeing any real problems in terms of the election. But, you know, to be fair, the last time the elections looked very smooth, and suddenly everything went all wrong. But even though there was a problem for a short period, companies still made it through that. Companies recovered. The ones that recover the slowest probably is tourism, because obviously you have to regain some confidence again. So there is some concerns for that. But also when we look at some of the tourism companies and we look at the product they're offering and how many rooms they're putting on and the opportunities over the next few years, we see any slowdown now and any reduction in their price as an opportunity to get in at a very good price.
Yeah, taking a look at you know, the entire picture right now. I mean, you know, we're talking about risk aversion being one of the factors at play now that's possibly deterring capital inflow into these countries, despite the opportunity that they put on. But even if risk aversion wasn't at play, and if we had a risk on appetite or environment in play, there's liquidity that also poses a significant challenge. Just how much of a challenge right now?
I mean, liquidity is one of the things we must manage very carefully while investing in Africa. And liquidity is an issue because sub-Saharan Africa has very low liquidity. Okay? Of course, if prices go up, your liquidity goes up as well. But liquidity is a threat in terms of two ways. It's something we have to be careful about in terms of managing our investments. But investors must be very careful about liquidity as well, because when risk comes on and people start to want to invest with relatively low liquidity, prices can move up very, very quickly. It's very easy to be left behind in an environment where there's not much liquidity.
Yeah, so certainly something to keep in mind. Sven, we're going to have to leave it there. Thanks so much for your time today.
Thanks.